Hi everyone, here's an update on the equity hedge fund that I've run. I'm up 15% for the year. Well, there's been a correction, but I'm not worried, and I'm busy buying good quality stocks on companies with wide moats and strong growth. With the latest correction, the bottoming process in equity markets is well underway. Investor sentiment has moved into bearish territory again. We continue to believe that a secular bull market is alive and that markets will likely move higher into the year end. The large cap space should be well prepared to handle the higher for longer interest rate environment. We see a good entry opportunity in US mega cap tech, healthcare and communications sector. The S&P 500 and credit markets still see no recession on the horizon. With risk assets correcting and short-term deposit rates at current levels, it's hard to withstand the urge to hide in cash. In my experience, we are seeing early signs that the rise in interest rates is coming to an end. Looking ahead 12 or even 24 months, there is plenty of value to be found in the bond and equity markets. The Magnificent Seven, which are Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta Platforms, and Tesla, are at new highs. Well, 30% of S&P 500 market cap is trading at 30 times price to earnings ratio, versus the rest of S&P 500 at 16 times. Back in April, Europe, with its own Magnificent Seven, which is Louis Vuitton, L'Oreal, Hermes, Dior, Richmond, Kering, Ferrari, traded at 36 times versus the rest of Euro Stoxx 600 on 13 times PE. So it shows that even though it's high, it can go much higher because these are good quality companies. Well, most of them, except Tesla, but they have the ability to get more expensive because higher growth leads to higher valuation. The biggest picture is that cash and treasury bills are at 15.4% of Bank of America asset under management, which is AUM, versus 13% historical average. So money market funds AUM are up US 1 trillion in 10 months to 5.7 trillion. That's loads of cash. Our best bullish shout where it ends up in 2024 is the cash on the sidelines. Investors first need a recession plus rate cuts, just like in 2009 and 2020, to sell cash and ignite new bulls. There is a lot of fuel, and cash is the fuel. Cash on standby will mean that once equity markets have hit the bottom, rates start to come down, investors will pour a lot of money into this equity markets, fueling multi-year bull runs. The economy in the US is not all roses as well. Credit markets have grown tight and corporate bankruptcies have spiked. We are in a credit crunch and most consumers are being hurt by higher interest rates. Mortgage rates have hit 8% in the US this past week, and indications are that mortgage applications have come to a screeching halt. Home foreclosures have been surging. They are at the highest level since the start of the pandemic. There have also been 516 corporate bankruptcies already this year, which has surpassed 2021 and 2022. The NAAIM, which is the National Association of Active Investment Managers, to which we are aligned to, has become slightly more positive recently. Well, if the markets begins to move up, their assets, these assets guided by these managers, will also likely help fuel a more positive market. The data is showing that the bears are back, claiming inflation, the Fed, and perhaps a war will send stocks much lower. We are taking the opposite side because seasonally, the last quarter of 2023 is very bullish and right up to the next year. So we are buying stocks, good quality businesses. And what if I'm wrong in my macro calls? What if the US stock market crashes? Well, the traditional finance textbooks tells us that the bulk of the returns of investors come from asset classes that you choose. For example, whether you choose cash, stocks or bonds, it plays the biggest part, and stock picking plays a tiny part. I disagree on that. Great investors like Warren Buffett, Lee Lu, Monish Pabrai, Charlie Munger, and Peter Lynch ignore economic outlook. Instead, they focus on choosing great businesses and holding them on for dear life. So what businesses do I invest in? Firstly, businesses with strong organic growth in revenue, free cash flow, and earnings per share. Number two, they demonstrate pricing power. They have raised prices above inflation rate without losing customers to competition. Better still, the more they raise prices, the more the sales increased. This is called a very formidable white moat. Number three, they must be scalable. Every incremental dollar in revenue increases margins. You do not need $10 of capex to generate $5 of revenue. Number four, they must be great stewards of cash flow and earnings and not spend it on frivolous things. Number six, I like service-based monopoly. A monopoly is a single player without any competitors. And the companies must have wide moat, high returns of capital, and preferably be buying back shares, because you generate a lot of free cash flow. The best way is to reduce the number of shareholders. And lastly, the company must have low debt, because a company without debt cannot go bankrupt. And they do not need to issue new shares in bad times to dilute shareholders. And what about companies that I avoid? Well, companies that need high reinvestments, high R&D, high capex. Number two, unpredictable cash flow. You do not know when they're going to start. Consumers are going to spend the next money. For example, cars, they can be delayed in consumption if there's a recession. So you do not know when your next purchase is going to be. Number three, intense competition, no moats. Four, the wasteful use of cash flows, management that engage in pet projects that does not increase the ROIC. And lastly, acquisition-based growth instead of organic growth. I hold good businesses for the long term, hardly touching them or taking profit when it rises. Only when it's ridiculously overpriced do I start to take profit, but even then I'll leave behind some amount of the shares, because even if it's expensive, because of the superb quality and a high growth, it is likely to go much higher. So unless there's something wrong with the businesses, I tend to hold them for the long term. And how do I know that my investments will achieve 15 to 20% return per year in the long term? Well, the S&P 500 achieved 10% per year in the last 50 years. That's total return, dividends, and capital gains. NASDAQ has returned 14%. In the last 10 years, the S&P 500 has achieved 12% per year. NASDAQ over 15. I'm picking the best 5% of the stocks in S&P and 500 and NASDAQ by using the criteria. And lastly, Charlie Munger said, over the long term, it is hard for a stock to earn a much better return than the business which underlies it earns. If a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you end up with a good result. Well, I look for businesses with returns on capital of over 15%, in fact, averaging 25%, and I try not to overpay. I only buy when there's a margin of safety. So I'm confident we're going to get there. Next, this is a list of the type of businesses I will be interested in as the top table, which is Apple, MasterCard, Visa, Adobe, Gilead Sciences, United Therapeutics Corp, Manhattan Associates. I will certainly avoid those at the bottom of the table, short of ServiceNow. because of some special reasons. I shall talk about the UK economy and whether the property market is investable. First, let's look at core inflation, which excludes volatile food, energy, alcohol, and tobacco. Well, the prices fell less than expected to 6.1%. In September, from August, prices charged by manufacturers, considered a good indicator of future inflation, fell by an annual 0.1% in September after a 0.5% annual drop in August. The Bank of England predicted inflation would stay above its 2% target rate until early 2025. So it's going to take a while for inflation to drop, but it is falling. Next, let's look at interest rates. Because of the fall in core inflation, interest rates are likely to peak in the UK in the late 2023 to mid-2024. This is the period where most of the distressed properties, especially commercial assets, will appear on the market at discounted prices. For residential properties, 57% of fixed-rate mortgages are coming up for renewal in 2023. They were fixed at below 2%. They will mature through the course of 2024. The number of fixed-rate mortgage deals coming to an end in 2023 will peak in second quarter, which is April to June this year. And it tapers off after that. So what happens to all the investors whose fixed rate mortgages end in 2023? They will have to refinance it at 6 to 7% interest rates when previously it was 2%. So some will not be able to service the loans. And if they are sitting on huge profits because they bought them long ago, they'll certainly put them on the market for sale. But if you're thinking that many distressed homes will be for sale, think again. Only 750 homes and 410 buy-to-let properties were repossessed in the first quarter of 2023. Banks say that they don't want to repossess homes and would much rather come up with a payment plan with customers. Also, stress testing by banks began in 2024. Some applicants were turned down by lenders. So the mortgage market is a lot healthier. Homeowners have a better balance sheet than in 2006 to 2009. Lenders are even now testing applicants to see whether they can cope with interest rates of 8 to 9%. And that's why I always say that you can leverage real estate safely as long as you service a loan. The banks are not intending to margin call or foreclose your properties. Whereas if you leverage on equities, options, the brokerages have no qualms margin calling you because there's no repercussion to them. So don't leverage on financial instruments. You can leverage safely on houses and get supernormal returns. Everywhere in the world, and in this example, which is London, landed houses are more stable and appreciate faster than apartments. That's because there are fewer supply of houses versus apartments. Typically, a terrace house in the UK appreciates by 6%, a semi-detached by 8%, a detached house by 10% per year, whereas an apartment appreciates by only 4%. Well, the yields for apartments might be higher, but that's not really true because service charges often eat away most of your returns. But the capital gains, remember, is what makes you rich. It is not the rental income. So if you really want to be financially free, you need to bank on capital growth, which that's why we preach buying semi-detached houses and detached ones. And for those of you who think that post-Brexit, the UK's population will shrink, think again. It's still growing by 0.4% per year, and that's higher than France, it's higher than the US. There might be less refugees, but more skilled workers coming into the UK from outside the EU. 2023 and 2024 are the best time to take action as prices have stabilized and may fall slowly. Every time prices stabilize or fall on the left-hand side, is followed by long periods of strong growth. Also, prices of apartments, which is a green line, tends to rise slower and fall faster due to greater supply versus landed homes. So if you would like to find out more about my fund or about our portfolio building services, where we help you build a portfolio of 10 properties in 10 years so that you can be financially free and do the things that you love, please help us to like and subscribe to our channels, and also reach out to us at hi@titanium-synergy.com. That is hi@titanium-synergy.com. We'll see you real soon.